gold is actually just beginning this third phase of its bull market. And today was that beginning. Gold and silver are absolutely on fire, and today marks the day of the third and final phase of this bull market. This is the day it began. And the third phase is the phase of the greatest gains in the shortest period of time. When I say this bull market, what I'm talking about is this bull market actually started at the beginning of this century, and this is one giant bull market. The correction that we have been through, the cyclical pullback, we went from the beginning of the century up to 2011, and we've been in a pullback, a cyclical pullback, in a secular bull market. So this cyclical bear, the bear portion ended in 2015. We've gone back up, and today we broke out into all-time record highs in the gold price, measured in US dollars. But since gold has been setting records in almost every currency, I would imagine that today, I haven't checked, but I would imagine that today gold is setting records in almost all currencies on the planet. You know, all currencies fall at different rates compared to gold. The dollar goes up and it goes down, and other currencies go up and down. But when it comes to comparing them against gold over a long period of time, and we'll see this later in the video, they all go down and pause and down and pause, and they may go up a little over a short period of time, but over a long period of time, they just go down compared to gold. Now, the fundamental change that has taken place that launched this this third phase, the last phase in this gold bull market, is investor sentiment, investor psychology. This has changed now from a greed-driven mania. That first portion of from the year 2000 to 2011 was a greed-driven mania. Gold went from $253 up to $1,900 an ounce, and that $1,900 an ounce was in August of 2011, but silver hit its peak in April of 2011, and that just is not how a precious metals bull market ends. Precious metals are geopolitically sensitive metals. They are money. And so when people get scared, they're scared of currencies, they're scared of debt, they're scared of overvalued stocks, they rush towards safe havens. Well, the safe havens, the U.S. Treasury, sovereign bonds, especially the U.S. Treasuries, have been considered the safe haven, but even those now investors are starting to doubt. And so the only safe haven left is gold. The only choice is gold and silver. There are two choices. And cryptocurrencies also. So I expect that some of them will do very well. But here we are we hit 1940 something today, $1,945 an ounce. So the previous high was 1900. So gold is up. It was down in the 1452.90, it says here, for the low on March 16th. And just a little over 4 months later, we're up more than a third, 33%. But silver has been the star of all of this. Silver back in March, on March 18th, was $11.69 was the low, and today we're over 24. So it's gone from under 12 to over 24. It's more than 100% gains in just a little over 4 months. But getting into the reasons why this has shifted from a greed-driven mania to a fear-driven panic is all of the things that are happening right now. Gold roars to record high, dollar dives again. Gold soared to an all-time high on worsening ties between the U.S. and China, a sinking dollar, and ultra-low interest rates. Now, we are going to come back and visit these factors numerous times during this video so you can fully understand what's going on here. Gold prices surged to record high amid coronavirus worries and U.S.-China tensions. But what's most revealing in this article is in a note circulated before the new highs, the Commonwealth Bank of Australia said that the fall in U.S. 10-year real Treasury yields is the most important driver. Now, I don't know if it's the most important driver, but it's one of the really big factors. And like I said, we're going to visit that and really take a look at it in depth later in the video. The U.S.-China clash has entered perilous new territory. And this is about a speech given by the Secretary of State. And in it, it talks about, it gives some context here. For some context to understand the dangers of our time, think of what's coming as an updated version of the period between World War II's end in 1945 and the Cuban Missile Crisis of 1962. Now, for anybody that doesn't know about the Cuban Missile Crisis, you should read about it because we came within hours of total nuclear war with Russia, with the USSR. Today, the number of missiles, the number of warheads that the two world powers had at the time was just a tiny, tiny fraction of what the world has today. So that is definitely worth looking up and reading about. Billionaire investor Ray Dalio fears for the dollar and the soundness of our money. Well, the author here isn't talking about money, he's talking about currency. Even when I keep on harping on the difference between money and currency and that no nation on earth today uses money, that what we all use is national currencies, even in the Federal Reserve Act of 1913, it says that Federal Reserve notes have to be backed 40% by lawful money being gold or U.S. Treasury gold notes. In this article, he says that there's a trade war, there's a technology war, there's a geopolitical war, and there could be a capital war. That's the reality. If you say by law, don't invest in China, or even possibly withholding the payment of bonds that the U.S. owes payment on in China, these things are possibilities, and they have big implications, such as for the value of the dollar, because pre-market, I believe what the author was meant to say here was free market, not pre-market, because free market investors are not used to having those things dictated by government. And this is true. If government starts saying, you can't invest in China, you got to sell your investments in China and bring that currency home, if they tell China that they're not paying them on all of the treasuries that we've issued, then that is bad news for investors worldwide, for worldwide trade, for just everything. That really sinks the world economy. And this is billionaire investor Ray Dalio. Moving on, the Secretary of State Stephen Mnuchin says that the GOP coronavirus relief plan is ready to go as unemployment boost runs out. We can move very quickly. But the point here is that they're about to pass another $1 trillion spending package. So they're going to spend another $1 trillion that we don't have. And if we don't have it, they've got to borrow it. If they're trying to borrow it in a time when investors are starting to get a little bit nervous about U.S. Treasury bonds, and in a time when Treasury bonds are yielding nothing, as you're going to see later on in the video, that means that the Federal Reserve will have to monetize this. They may go into the open market for a little while, but within weeks, it'll be the U.S. Fed that owns these bonds, not private investors or brokerage houses and such. So look for the Fed's balance sheet to go from $7 trillion up to $8 trillion within just a few months. And then Larry Kudlow, the White House economics advisor, says coronavirus relief will include $1,200 for everybody. So these are those checks falling out of the sky from the currency bombers that we have in episode 7 of Hidden Secrets of Money. So this is more of the, part of the expansion of the currency supplies and the loss of confidence in fiat national currencies, because this is a global event. Joint EU debt must not become a regular thing, says Germany. And in here, they are going to try to raise up to 750 billion euros in the capital markets. So that means the EU will be selling 750 billion euros worth of bonds in the markets. And that the exchange rate puts that at 0.875 trillion US dollars. So 875 billion US dollars. Then moving on, world trade continues to slide as recovery sputters. So last month there was a 12.2 drop in world trade, and that's expected to be the decrease month on month. This month is another 1.1%. So world trade is slowing down. And then this chart sort of says it all. This is the Bloomberg Dollar Index, the 5-year U.S. real Treasury yields, and the gold spot price. And so gold is the purple line in the background. The white line is the dollar. And then this blue line is treasuries. And you can't expect everybody to rush toward treasuries when they're not paying you anything, and when gold has been showing such spectacular performance as a 33% gain in 4 months. And here you're being promised just a pittance. This is the yield curve chart, and I've shown this many times. But take a look at how low this yield is, and let's go through from the late 1990s, and when we could see that, you're up at 5-6%, and then the yields change. And this is an inverted yield here, where the 10-year is below the 2-year, and that predicts a market crash. And we had a market crash. And then the yields come back up, and it inverts again, and we have another market crash. But now look at what happens with the amount that the 5, the 10, and the 20, and the 30 are yielding. And that amount is shrinking, and we still have a positive yield curve. We had almost an inversion here, but the yield curve came back down. And this is at the beginning of this year. So this is the end of January. And yields were still decent. And this is what the yields are today. They're just absolutely nothing. And the great thing about this chart, you can click through and you can see that you get 1.23% if you loan the government your currency for 30 years. And then if you only want to loan it to them for 10 years, you're going to get 0.59%, 0.59% annual for 30 years. And the 5-year, we'll go to the 3-month here. The 3-month is currently at 1.1. You have to actually look at this. You can't look at it logarithmic because it's just absolutely broken. The whole monetary system is broken. And that's what these things, this is the 5-year, down at 0.27%. Just absolutely insane. So moving on, the US dollar has been falling. And what you see right now is it just broke below 94. So we're at about 93.5 roughly. We're at 93.6. And taking a long view of the US dollar, here's the US dollar going all the way back to 1973. And the reason it doesn't go back before that much is we didn't have these exchange rates. The Forex really didn't exist before August 15th, 1971. Basically, before August 15th, 1971, this chart from 1934 to 1971 would have been a flat line, and it would have said $35 because it was $35 per ounce of gold all the world's currencies were measured against gold, not against this floating basket of currencies. And as you'll see in a moment, these currencies are all falling over the long period of time against gold. But if we take this dollar index and we zoom up on it a little here, we're going to go to just the last 10 years of this dollar index, and I'm going to hit annotate. And there's something wrong with stock charts right now. If I draw a line over here, it comes out way over here. So I'm going to take that, I'm going to put this right at the bottom of that, and draw a trend line here. And what it shows is that we're now at 93.6, so we're right up here. So we've just broken this trend line that goes back 10 years. This is very important. Now, another thing to notice here, if you know what a head and shoulders pattern is, this is sort of a tilted head and shoulders. You've got a shoulder, a head, a shoulder, and if you break that neckline, we haven't decisively broken it yet. The dollar could still bounce, and if it does, then then gold will do a pullback. We'll get a little bit more time for this all to play out, and I'm actually hoping that that's what happens here, but it may not. If anything else goes wrong in the economy or geopolitically, we could see this fall. And if it decisively breaks this pattern, then this head and shoulders is sort of suggesting you take the center of this neckline, and so from that point right about there, and you use that like a hinge, and you flip this upside down, and it's predicting the bottom of this chart. So this low 10 years ago would become support at that point. So that's potentially where the dollar is headed, and if that happens, gold is going to soar, and it will be soaring very quickly. These are a bunch of ifs, but if the dollar falls, gold will be going up, and it'll be going up big time. Now, I wanted you to see, this is the US dollar, that same chart. So this chart here, this is the US dollar, but when you measure it in gold, that dollar measured against a basket of currencies, then measured in gold, it looks a bit different. And then if you go over a long period of time, this is going all the way back to 1973, you can see that, the dollar has a parachute on it. It's falling more slowly than some of the other currencies. And so, but compared to gold, it's going down. And the best way to look at this is on a linear graph instead of logarithmic. That's the same graph produced linear. We've gone from 1.7 down to 0.05. So that is gold as compared to the US dollar. And again, there's just the US dollar, not measured in gold. And even that against the other basket of currencies. You draw a trend line across here, and the dollar is falling against that basket of currencies. Then, moving on, US dollar at risk of sudden collapse, ex-IMF official warns blow-up event could sink currency as debt mounts. So, that is the point of this whole video here, that gold is actually just beginning this third phase of its bull market. And today was that beginning. We just broke above gold's previous all-time high. Now, as a percentage of the Federal Reserve's balance sheet, gold is on the Federal Reserve's balance sheet. Gold could back the dollar once again. As a percentage of the current balance sheet, gold makes up 0. So again, it starts with 0.157% of the Federal Reserve's balance sheet, and that is at the statutory price that the Federal Reserve and the U.S. government observe of $44.2222. So it's $44.2222, which is a ridiculous price. But even if you bring it up to today's real price, that puts the gold at just 7% of the Federal Reserve's balance sheet, making it would have to go up roughly 14 times from where it is to cover all of the, if you wanted 100% coverage of all the dollars that the Federal Reserve has created as of today, you got to add that there's another $1 trillion coming real soon, folks. But if it was to cover all of the Federal Reserve dollars, not the dollars that all the banks create, the 8 trillion that exist, not the 23 trillion that exist in as far as MZM, money of zero maturity, shows, all the dollars that the banks create. This is just the Federal Reserve dollars. It would be $26,000 an ounce. Now, if they're forced, if we end up having to go back to some sort of gold standard, they would do some sort of phony reserve ratio, or maybe they only back the currency in circulation. But you're talking about some pretty spectacular numbers all the way around. So when you take a look at where gold is adjusted for inflation, now this is using ShadowStat's alternate CPI, which is the original CPI that existed before 1980. And using that CPI, that original basket of goods and services, unchanged for all this hedonic adjustment and replacement and substitution and all these things that the Bureau of Labor Statistics does to make the consumer price index look good, make inflation look lower than it really is. All of those things have altered the CPI. So going back to the original, John Williams of ShadowStats.com recreates the original CPI, but the truth lies somewhere in the middle. I think his alternate CPI exaggerates inflation, and the government's CPI underestimates inflation. But this article this is a chart from an article that Jeff Clark, our senior precious metallist at goldsilver.com, did either at the end of 2018 or the beginning of this year, and it showed that gold just hit an all-time low using the 1980 CPI. And even using the government's CPI, we have yet to clear this the 2011 high. We've got quite a ways to go just to clear that. So gold has a long way to run. That is the point of today's video. So I want to thank you very much for watching. We'll see you next time. At this point, the boys at the Fed will buy enough government debt to fund tax rebates for all the taxes in the previous year, but still, nobody will buy that new car. The threshold the Fed is looking for will not be reached. Then, in not-so-quiet desperation, the Fed will say, "Screw the helicopters, send in the bombers." And as the shadow of millions of stealth currency bombers darken the skies, currency will begin to fall like rain in the desert. As Joe Sixpack and John Q get tax rebate checks in the mail for all the taxes they paid during their entire lifetimes, fear will be temporarily alleviated and some of that currency will come out of hiding, just as in Weimar Germany. Prices will rise quickly and dramatically as all that stored up currency energy is released. In a panic, the Fed will call back the bombers, but it will be too late. There's nothing they will be able to do to stop it now because the hyperinflation will have already begun. The Dow will begin an invisible crash of epic proportions and gold prices will shoot to the moon. If you are wise enough to moor your boat in the safe harbors of gold and silver and other commodities, you will weather the storm. It won't be pretty, but at least you'll be safe. At this point, confidence in the currency will fall faster than it can be created.